Hi, everybody. If you're working as an accountant in India, it is super obvious that if you can do US accounting work, you can get paid more and get better jobs. So, why can't people who know Tally start using QuickBooks or Xero and start earning in dollars already? Most Indians with a background in accounting or bookkeeping are unable to tap into US accounts because of one mental handicap that they don't know US GAAP. Even those who have pursued MBA degrees, CA or CMA programs didn't learn about it. Let me tell you, everybody, learning about US GAAP is not hard at all. Even if you're a BCom student, you can do it. In less than 25 minutes, we will teach you at least 5 key US GAAP principles for common bookkeeping and accounting transactions right now. You can decide after that. I will also compare this with Indian practices. Our normal accounting on Tally, which most accountants and bookkeepers perform, is as per Indian GAAP. Listed companies and certain other large companies follow a different standard called Indian Accounting Standard, which has quite a few similarities with IFRS in Europe. Let us see how to account for US GAAP for 7 key terms. We will compare US GAAPs with Indian AS here. Let us start with how the financial statements are to be presented first. Presentation of profit and loss account, income statement, and statement of cash flows. I'll start with an easy one first. The differences in the profit and loss account and statement of cash flows here are largely cosmetic. Under US GAAP, the income statement, that is profit and loss account, and statement of cash flows has to be presented for 3 years so that stakeholders have a comparative view. Under Indian AS, applicable to large Indian corporations, it is to be presented for 2 years. Next, treatment of lease. How do you account for a simple office lease? Under Indian AS, lease expense rental is treated as an expense in the year in which it is incurred. Plain and simple. US GAAP categorizes lease differently. In a US financial statement, a typical lease is called an operating lease. In addition to recognizing the expense in the year that it is incurred in, under the profit and loss account, there is one more step that is to be taken. If the lease is over 12 months and has material value from the perspective of the company's business, it will be classified as a right of use asset under the balance sheet. This is clubbed under plant, property, and equipment, where such leases may be referred to as ROU assets. Here is how it is shown. We will see the Freshworks latest 10K statement, that is annual statement filed with the SEC. Here you go. You see. The value of the future payments that must be made is also accounted for. How do you account for the present value of a future payment? Typically, a discounted rate is used, which must be disclosed in the financial statements, like so. Have a look. Here are the leases, the operating leases, December 31, 2022. So you see, you saw this one. Here are the lease term and discount rate. And here you have the leases, operating leases. Now, did you get some idea of this? We're just getting our hands dirty right now. It will take you some practice and feedback to master it. Don't worry, this is totally doable. Our students do it in a period of under 3 months. Third one, everybody, treatment of inventory. Inventory treatment is mostly for manufacturing businesses, processing, and assembling industry. Those who are using Tally software in India for such businesses are already comfortable with it. If you are not, you can learn that. Under US GAAP, inventory is valued as per LIFO method, that is last in, first out. This can feel like a little bit of a juggle to figure out. Now, why is the choice of costing method important? Let me give an example. Imagine that I am an iPhone retailer. I have 10 iPhones of rupees 1 lakh, which I purchased earlier and 10 iPhones which I purchased later at 1.5 lakhs each when the price had increased in the global market. Total cost of these 20 iPhones inventory is 25 lakh. The first 10 and the next 10 iPhones had a different cost. When I sell an iPhone or if I have unsold inventory, what cost should I value on my books? Should I take the average into account? The average cost of an iPhone is say 1.25 lakhs now. It will be too impractical to map the cost based on the serial number of the iPhone. Hence, US GAAP sets a uniform principle for it. Let's assume that at the end of the year, I have 10 unsold iPhones. Should I value them at 1 lakh, 1.25, or 1.5 lakh each as per my books? Under Indian Accounting Standard and IFRS, I cannot use LIFO. I must use FIFO, first in, first out, or weighted average cost. As per FIFO principle, I must assume that the first 10 iPhones got sold and the unsold ones are the ones I bought last, that is at 1.5 lakhs. That means I can use 1.5 lakhs or 1.25 lakhs as the value. Most businesses use a weighted average method. Under US GAAP, you can also use LIFO apart from the above methods based on the accounting policy of the company. That means you can assume that the more expensive iPhones were sold first. Now, what does this mean for US businesses? In short, businesses have more freedom to choose the inventory costing method subject to disclosure. Of course, there will be restrictions on changing the accounting policy as that will prevent comparison of results across years. How does this affect the financials at the end now? The choice of costing method will dictate the value of the company's unsold inventory on the books at the end of the year in the balance sheet, and it will also impact their cost of goods sold item, thus directly impacting profits. Fourth one, everybody, valuation of fixed assets, including intangibles. This is another interesting one. Let's assume that Walmart purchased a warehouse from Apple in the US at $10 million. This warehouse is in a prime location and is currently valued at USD 25 million. However, the warehouse is not sold. How should the fixed asset be shown? Should it be shown at 25 or 10 million? Under US GAAP, it must be shown at historical cost, that is $10 million. However, under Indian AS or IFRS, you have to revalue the asset at 25 million. What if the value of the warehouse had fallen to USD 8 million? Same answer. In the US, you will continue to show it at historical cost, but under Indian accounting standard, it will be revalued. Now, how are these gains or losses shown when the asset is revalued? Well, in the US, this situation does not arise. Under IFRS and Indian accounting standard, the difference is reflected as an entry in the profit and loss account in other comprehensive income if there is a gain. And if there is a loss, then it will be shown in the P&L as non-operating expense. These gains or losses are recorded as non operating expenses or other income because they arise from non core product or service related expenses, that is, assets. Fifth one, everybody, contingent liabilities. How are commercial transactions such as guarantees accounted for? How do you account for the risk of a liability if the court requires your client to pay damages to a third party? In all these scenarios, the liability is currently not certain, it is contingent. Let us say that there is a guarantee provided by your company, or there is a legal proceeding against the company from a vendor or a tax notice, which could potentially result in a liability of $5 million. dollars. Under accounting standards, typically the company management is required to exercise judgment on the likelihood of the outcome. Under US GAAP, if there is a high likelihood of an adverse outcome that is over 75%, a provision needs to be made. Under IFRS, a provision needs to be made if the likelihood of loss is 50% or more as per the management. This must be shown in provision for tax or provision for claims. Under Indian accounting standard, this is not required to be provisioned unless the legal department or lawyers confirm that there could be a liability, plus there are necessary documents to establish the risk. Sixth one, product development cost. How should research and development expenses be treated? Apart from manufacturing companies, tech companies, especially new age startups, invest massively in building startup products and apps that can be used for a period of several years. An app developed in 1 year could be used for another 5 years. Of course, incremental changes and maintenance can be accounted for separately. Can a US company divide its development cost over 5 years though? Its profitability could be massively higher. Unfortunately, under US GAAP, the entire product development cost must be expensed out in that same year if it is not the physical product. There is an exception for software. Software development cost can be capitalized as an intangible asset and then it can be amortized over the estimated useful life. Under Indian accounting standard it is possible to capitalize product development costs in the books of accounts. Research costs, however, cannot be capitalized. Number 7, revenue. Under US GAAP, revenue is to be recognized when the product is sold or services provided, as that is when you have the right to earn an income. It follows a 5 step model. IFRS and Indian accounting standard are the same. However, Indian GAAP, applicable to most private companies, does not follow this. They rely on certainty of realizing the income. If there is a doubt about whether payment will be received from the other side, revenue may not be recognized. In India, many clients do not pay or pay on time, even if there is a contractual right to earn. So there is a scope to not recognize revenue if payment is uncertain. US GAAP does not allow this. Now, how did you find this, everybody? Did you learn even one new concept? Do you think that with some preparation and practice, you could get better at this? This is just the starting point. Tomorrow, I will also send you a video to explain this in detail. You should know how to do such work with respect to 20 to 30 items to be able to do this work for a US startup or SME. Once you learn how to do this, it is possible to present recast financial statements as per US GAAP very easily. And then you can learn how to use bookkeeping and accounting softwares like QuickBooks. It is possible to learn this under 3 months. The big four accounting firms and a handful of Indian accountants who discovered this opportunity are already doing this. They hire accountants in India, train them on a few important tasks in 1.5 months, and then do global work from India. The problem is that while they earn very well for this work, the Indian accountant or bookkeeper who works for them gets paid only 30 to 50,000 per month. Also, they are working only for the top 5% of the large corporations. 95% of the businesses there are startups, SMEs, and CPAs who run smaller practices who cannot offshore such work to the big fours. If you can learn how to do this work and how to find and pitch to US clients, you can directly work with the US clients and earn 3x to 5x than in the Indian job market. The market is very big and untapped. You have a massive cost advantage if you learn how to do the work. And there is very little competition as compared to Indian jobs. The US is going to face a talent shortage as well. Here, everybody. 300K accountants and auditors in the USA have quit over the last 2 years. Can Indian accountants fill this gap, everybody? More than 300K accountants and auditors have left. Many CPA firms and small businesses are scrambling to fill the gap through outsourcing. Will this bring opportunity to Indian CAs and accountants in general? That is the question we need to answer, everybody. Now, much of these opportunities can be taken up by Indian bookkeeping and finance professionals remotely. They don't need to have a CA, CMA degree either. Do you want to learn how to do this? You need to learn how to find clients and how to do the work. Join our free 3 day live online bootcamp for a full roadmap, everybody. We all also teach you how to find clients and several other practical skills like how to use accounting software like QuickBooks or Zero, and you can deploy them right away. By the way, these softwares are far easier to learn than Tally. I'll see you there.